Have you ever noticed something strange about your trading? Your biggest losses usually do not come after losing streaks. They come after winning. You win 3 trades in a row. Everything feels aligned. Your entries are clean. Your analysis feels sharp. You are reading structure perfectly. The market feels predictable. You start to feel in sync with price. Confidence rises. Execution feels effortless. You begin to trust your instincts more than your checklist. You tell yourself that you are locked in today, that you understand the rhythm, that you are seeing what others are missing. And that is exactly when discipline starts slipping. Not loudly, not dramatically, subtly. You enter a little earlier than usual because you feel sure. You size up slightly because you feel ahead. You take a setup that is almost valid because you believe your read is strong enough to compensate. You do not feel reckless. You feel skilled. That is the danger. The market does not destroy you when you are weak and doubting yourself. It waits until you feel invincible. It waits until confidence quietly turns into assumption. It waits until you stop protecting capital because you believe you cannot miss. And in that moment, the shift begins. After a series of wins, something subtle begins to happen inside you. It feels like growth. It feels like improvement. It feels like your skill just leveled up. But what is actually happening is psychological. Every time you win a trade, your brain releases dopamine. Dopamine is the chemical associated with reward, pleasure, and reinforcement. It tells your brain, this behavior is good. Do it again. Now, here is where the trap begins. You start to associate your recent success with increased ability. You tell yourself that you are sharper today, more intuitive, more accurate. You begin to overestimate your edge. Winning does not increase your skill. It increases your emotional intensity. The strategy did not suddenly evolve. The market conditions did not suddenly become easier. Your system did not magically improve within 30 minutes, but your confidence did. And that confidence quietly starts adjusting your behavior. You stop waiting for full confirmation because you feel ahead of the market. You size up slightly because you feel safe. You take setups that are almost there because you believe your read is strong enough to compensate. You skip parts of your checklist because you feel locked in. And you justify it with a simple sentence. I've been seeing the market clearly today. That sentence has destroyed more accounts than bad strategies ever have. Now let's break down what is actually happening in your brain. First, there is a dopamine spike. Each win reinforces the behavior and strengthens the emotional high. Second, your perception of risk decreases. The same setup that felt risky this morning now feels comfortable. The same lot size that once required caution now feels small. Third, impulsivity increases. You make decisions faster. You analyze less. You trust instinct more than structure. Fourth, you develop an illusion of control. You begin to believe you are influencing outcomes instead of participating in probabilities. When you win repeatedly, your brain slowly begins to believe, I can't miss. And that belief is dangerous because statistically, nothing changed. The market does not reward your last 3 trades. It does not care about your streak. It does not remember your accuracy. Every new trade resets the probability. Probability has no memory, but your ego does. And when your ego starts trading instead of your system, discipline quietly fades. Overconfidence does not destroy your trading instantly. It follows a pattern. And if you pay attention, you will recognize this pattern in your own history. Phase 1 is precision. This is when you are sharp. You wait for clean structure. You respect your risk. You let the setup fully form. You are patient. You are disciplined. You are trading your system exactly as designed. This is usually how the winning streak begins. Phase 2 is comfort. You start feeling relaxed. You begin to trust your read a little more than your rules. You enter slightly earlier because you are confident price will move. You widen stops just a bit because you feel the trade needs room. You increase lot size because you believe you are in rhythm with the market. Nothing feels reckless. It feels logical. It feels earned. Phase 3 is sloppiness. Now you start forcing setups. You see structure where there is none. You ignore higher timeframe bias because you feel your lower timeframe read is strong enough. The first loss hits, and instead of resetting emotionally, you immediately look for another trade to maintain the streak. You revenge trade without calling it revenge trading. You are no longer trading the system. You are defending your confidence. Then comes phase 4, the emotional crash. You give back profits, sometimes all of them. Confidence collapses. You start questioning your strategy. You start wondering if you ever had an edge at all. The same market that felt clear now feels confusing. The same setups now feel uncertain. And here is the painful truth. The same confidence that built the profits becomes the reason you lose them. Now let's talk about something most traders misunderstand. Winning is often more dangerous than losing. Losing makes you cautious. Winning makes you careless. When you lose, you analyze. You slow down. You double-check your entries. You review your rules. You become hyper-aware of risk. But when you win, something different happens. You feel validated. You trust intuition more than rules. You loosen discipline because the recent outcome seems to confirm your ability. You feel in control. And that feeling of control is where discipline starts fading. Most traders fear losing streaks. They believe losing is what will break them. But it is the winning streak that silently breaks them because losing humbles you. Winning inflates you. And in trading, inflation of ego is far more expensive than a temporary drawdown. Let's be honest for a moment. How many times have you increased your lot size after a good day? Not because your strategy changed, not because your risk plan evolved, but because you felt confident. How many times have you taken a trade outside your plan because you felt locked in, because you believed you were seeing the market more clearly than usual? How many times have you told yourself, let me just take one more trade. I'm on fire today. And how many times did that one extra trade erase half your profits? This is where real growth begins. Not in pretending it never happens, but in recognizing the pattern without defending it. Overconfidence does not feel dangerous when it is happening. It feels empowering. It feels like progress. It feels like elevation. But discipline is not tested when you're losing. It is tested when you are winning. The moment you feel untouchable is the exact moment you must become more controlled. Now, let me give you something practical, a rule that protects you from yourself. I call it the reset rule. After 2 or 3 consecutive wins, you do not speed up. You do not scale aggressively. You reset. Take a 10-minute break away from the screen. Physically step back. Let your nervous system settle. When you return, reduce your next lot size by 25%. Not because you are scared, but because you are stabilizing your psychology. Then reread your trading checklist. Every rule, every confirmation, as if it is your first trade of the week. And ask yourself one powerful question. Would I take this exact trade if I was on a losing streak? If the answer is no, then your ego is trading, not your system. Trade as if you just lost, even when you just won. That is how you keep confidence neutral. That is how you protect profits. That is how you stay professional in a market that constantly tests your emotional control. Now, let's go deeper. There are 2 types of traders in this market: outcome-driven traders and process-driven traders. Outcome-driven traders trade based on how they feel after wins. When they win, they feel skilled. When they lose, they feel incompetent. Their identity moves with their results. Their confidence rises and falls with every trade. Process-driven traders operate differently. They trade based on rules, regardless of emotion. A win does not make them feel superior. A loss does not make them feel broken. Their identity is tied to execution, not outcome. Overconfidence only truly damages traders who identify with outcomes. If your identity is, I am good because I won, then every win feeds your ego. And when ego grows, discipline weakens. You start protecting your image instead of protecting your capital. But if your identity is, I follow my process, then wins do not change your behavior. Losses do not change your behavior. You measure success by execution quality, not by short-term results. Your edge is not your last trade. Your edge is your discipline. And discipline does not get louder after wins. It gets quieter. It becomes more intentional. Now think about your own experience. How many of your worst trading days started as your best? How many times did confidence slowly turn into carelessness? How many times did a strong morning session create a reckless afternoon? Are you actually consistently profitable? Or were you temporarily lucky and emotionally inflated? The market does not reward confidence. It rewards consistency. It does not care how you feel. It responds only to probability, risk management, and execution. If this message exposed something in you, comment one word: discipline. Not for me, for you. Subscribe to the Daily Trader Mindset if you want to master the psychological patterns that quietly destroy traders and learn how to control them before they control you.